Thank you for joining us for our webinar today, Retirement Income Planning. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenters today are Jamie Dressler and Keith Kuzera. Jamie and Keith are both wealth managers with SVA Financial Group. They specialize in providing comprehensive financial planning to their clients, as well as asset management, investment analysis, education planning, and Social Security planning. And with that, I will pass it over to Jamie to get us started today.
Thanks, Jen. Today we wanted to talk a little bit about business transition planning, and our hope is that you're able to walk away from this webinar with maybe at least one piece of information that can help you in your own business transition planning. We'd like to start today with a little bit of a few survey results from the Business Enterprise Institute. The Business Enterprise Institute is an organization that specializes in helping businesses manage transitions. And the first question of the survey that they went out to their participants was, what percentage of business owners are expected to transition out of their business in the next 10 years? And the answer is 79%. Now, this number probably isn't surprising to anyone, especially when you lay over the fact of what the general U.S. demographics are. Baby boomers are getting older, there's a lot of them, and people can't work forever. And so as people get older, the need to retire certainly comes up. And if you're a business owner, retirement generally means that you have to figure out a way to get out of the business that you're currently in. The second question is, what percentage of business owners have discussed their transition plans with their family? And that answer is 78%. We think this is fantastic and also coordinates with what we see anecdotally, which is business owners are very happy to discuss their business plans and their transition plans with their family to keep them informed of what they're doing. The third question is really the most informative, which is, what percentage do you think have actual plans in writing? And that answer is 17%. So only 17% have business transition plans in writing. And if you want to think about this in another context, a good analogy is if you were to pass away without a will or any estate plan in place, that really is the same type of risk that you put in place with your business if you haven't thought through the entire process of business transition planning. So we hope today that our presentation, our webinar, will help you move forward in that process. The business transition planning process really is a long process. There's a lot of steps. Today we're going to focus on just one particular area, which is the personal wealth and estate planning. All of these areas are important, and we hope that as you go through your process you'll address all of them, but today we're just going to focus on the personal wealth and estate planning. Family readiness. One of the most important things as you think about your business transition plan is to think about, is your family ready? Having your family ready can mean a lot of things to a lot of different people, such as, what are you going to do after your business is sold? Are you going to remain involved in the business somehow? Are you going to travel abroad? Are you going to spend time with the grandkids? What is it that you're going to do? Having that plan is really important. But to know what your plan is and to outline your plan, the tools that we think are important for you to outline those goals is a financial plan. And a financial plan really consists of many different pillars, from investment management, cash flow planning, tax and distribution planning, risk management, charitable giving, and your estate planning. These are all the aspects that make up a comprehensive financial plan. In today's presentation, we hope to talk just a little bit about three of them: tax and distribution planning, cash flow planning, and estate planning. Tax and distribution planning really comes down to two specific activities. And the first is choosing to tax and distribution planning is really understanding the two opportunities that you have to manage your taxes in retirement. And if you think about the two ways that you can do that, you can either pay tax early, or you can do everything in your power to defer the payment of taxes that you owe. And when you separate those two activities by time, that's really the strategy that people can put in place in order to have a significantly better tax outcome for their retirement assets. And if you pay less money in tax to the government, it means you have more money for yourself to live on. So you're able to stretch out and add value to assets that you have to get the maximum output from those. The way we like to think about distribution planning is really our three-bucket approach, which is to understand that there are three different categories of account types, and each account type has its own special tax strategy. Our goal is to make sure that we take advantage of all three of those to minimize the total amount of tax that is paid. So for example, in the first bucket, what you have is what we would refer to as a taxable type account. So if you were to buy one share of Apple stock in an account like this, and it grew from $1 to $2, the growth from that $1 to being $2 when you sell it would be handled using capital gains tax rates, which generally are 15 or 20%. The second category is tax-deferred type accounts. So think about accounts you might have that are IRAs, 401ks, 403bs, and other tax-deferred accounts. These work by you earn money from an employer, and then you put the money into the account, but you don't pay any tax on it when you put the money in the account, but you do pay tax on every dollar that you withdraw from that account. The third type is anything that starts with the word Roth. So Roth IRA, Roth 401k, Roth 403b, etc. That account works the opposite of a tax-deferred account. You pay tax on the income before you put it into the account, but then every dollar that you pull out of that account, you don't pay any income tax on. So you can see they're all taxed in very different ways, and what you want to try to do is blend the three together in order to maximize or minimize your tax, maximize your asset, minimize your tax liability. One example that we have that we'd like to share with you today to highlight that point, there's the first two bars. The first bar represents the value of a fictitious account in a tax-deferred type account. So let's assume you have an IRA and it has $460,000 in it. The bar in the middle represents the value of that account if you have to take the money out of that account at the various tax rates. So if you take money out of that account fast, it means you could possibly pay 35% tax on every withdrawal out of that account. But if you can take the money out of the account much slower, it's possible that you can pay a 12% tax rate on that amount. And as you can see, if you have to take it out fast, the account is really only worth $357,000. But if you can take it out slow, the account's worth $425,000. So our goal in tax and distribution planning is to figure out how you can slow the distributions from these account types, and you can do that if you supplement with the other two account types so that you can, in general, pay less tax over your lifetime. So if you're able to pay less tax over your lifetime using strategies like this, one of the things that we anecdotally see is that you can pay as much as 10% less tax over your lifetime by managing these strategies for your personal circumstances. Next up, we're going to have Keith talk to us a little bit about cash flow planning.
Thanks, Jamie. One of the basic concepts of financial planning in general is cash flow planning. When anybody thinks of financial planning, the cash flow planning is usually what comes to mind. And really, there's two ways to approach cash flow planning for retirement planning or financial planning. There's the top-down approach, how much do I need in retirement, or the bottom-up approach, how much do I have, how much have I saved, and what will that get me in retirement? So when you look at that bottom-up approach, you look at the sale of your business, you look at what you've saved in your retirement accounts, and then come up with that number right there. Then you have to figure out how long am I going to live in retirement, what sort of standard of living am I going to need and what sort of return am I going to get on those funds right there. And that's how you back into that number. This next slide here shows the top-down approach. It's really looking at that income replacement need in retirement. So you start with your current standard of living. In this case, we're using an example of somebody who's living on $150,000 a year in their current income. Now you start to reduce some of the things that are going to go away when you hit retirement. Things like your retirement savings, things like your standard business expenditures. Hopefully you've done the tax planning, like Jamie referenced, very well before you get to retirement, and then you should be in a lower tax bracket in retirement. So you can almost reduce 25% of what you're currently living on and still maintain that standard of living that you had pre-retirement. Now, don't discount Social Security. Social Security is going to be there. We don't necessarily know what it's going to look like in the next 20 to 30 years, but for anybody that's approaching retirement, I think it's a pretty safe bet that it's going to remain about the same as what you're promised right now. So don't discount that. So looking at this example right here, you'd almost need to have saved about 50% of your current income on an annual basis in order to maintain that standard of living. But that's what part of the planning process comes in to determine how much you're going to have or how much you're going to need in retirement. Now, Jamie, what is one of the biggest expenditures in retirement?
Healthcare.
Healthcare. That's a great answer right there, because I take a look at two individuals here, Joe and Jane. They're our happy business owner couple, and they're asking themselves, can we retire at age 58? Should we wait till 62, or do we have to wait till that magic number of age 65? 65 being when you're eligible for Medicare. Now, this next slide shows how much it's estimated you're going to need if you are hanging it up before you become eligible for Medicare. For example, if they've retired at age 58, they're going to need about $150,000 out of pocket to self-insure before they become eligible for Medicare. Now, if they're not in that healthy category right there, they're probably going to need closer to that $230,000, $240,000. If you wait till age 62, you can almost cut that first number in half. So you need to either come up with that money or come up with some strategies on how to self-insure before you hit Medicare. The next one shows what you're going to need to come up with when you do hit retirement. Medicare is not going to cover all of your expenses, but you should expect to pay something out of pocket once you hit retirement. So we're showing a healthy couple is going to need probably $500,000. Somebody who's not healthy, probably $1 million to sustain them for 20, 25, 30 years in retirement. So the moral of the story is, don't break the bank. Go through that planning process and determine how much you think you're going to need for the healthcare costs, either prior to age 65 and through the end of your plan. Now, Jamie, what sort of planning needs are going to need to be put in place in case of a catastrophic event?
We're going to talk about the estate plan to handle those kind of catastrophic events, Keith. So our third aspect here today that we want to refer to is our estate planning and how that might affect you in your business transition planning. And one of the things today that we really hope to focus on is to highlight the difference between fair and equal. On the surface, one might think, well, fair and equal, that should be the same thing. We'd like to hopefully illustrate an example here for you today that really highlights that difference. Having an estate plan while you're doing your business transition planning really is important. Just like I highlighted earlier, if you were to die unexpectedly without a will, there's serious impacts for your family no matter when that happens in your life. But if that happens during your business transition plan, it can really be catastrophic for the wealth that maybe has been created over your lifetime for your family. So our example, we're going to continue on with the Joe and Jane example. And we're going to go back in time 15 years and put together a little profile very quickly for a family. So maybe 15 years ago, Joe and Jane had been working on their business, and the business was worth about $300,000. Things were really just kind of getting kicking for them. They really put significant time in, and they got their business value up to about $300,000. Their total estate value was maybe $600,000. They've got 3 kids. All of them are either in college, entering college, or finishing up in high school. Chances are at this point in time in this family's life, if something were to happen to Joe and Jane, they probably had Grandma and Grandpa listed as their power of attorney for the kids, and if they were to die, their assets would be divided by 3 and given to their children, and all is well. The distribution of the assets were both fair and equal. They were, in fact, likely the same. Fast forward to today, and Joe and Jane have built significantly more value in their business. The business value now is $4.5 million. Joe and Jane have gotten a little bit older, but their total estate value now is $7 million. The other thing that has happened over this period of time is hopefully, if Joe and Jane ever needed a power of attorney, they took advantage to maybe have their kids be their power of attorney, but if our experience is anything, that is not the case. It's probably still listed as Grandma and Grandpa. But now as life moves forward, as people move from their 20s into their 30s, parents have this knack to kind of have an understanding of what their kids' capabilities or constraints are in their lives. And so now the 36-year-old child is actively involved in the business and does a great job running the business. The middle daughter, 34, she's a PhD at Stanford. Her life is really moving in the right direction. But the third child, they've realized now has some type of bipolar that this individual is working with, and that individual is really struggling with maintaining his life. And so now, if Joe and Jane were to pass, the worst thing you could do is divide your assets by 3 and give them to all 3 of the children. Instead, what you do is you work out, again, the difference between fair and equal, and the number isn't the same. So possibly for the first child who's actively involved in the business, part of the estate plan is to address that the majority of the business is inherited by that son. The daughter who's not actively involved in the business is doing well on her own. Maybe you figure out a way to pass on the value of your home and maybe a retirement account to that child. The third child, you address the needs specific to that child, and maybe in this case, you have a trust set aside so that that child receives a monthly income for the rest of their life because that individual is really not going to be able to take care of themselves. Very much fair, but not equal. And so going through that exercise in estate planning to understand the difference between fair and equal, we really think is important, and we find it in all the time with our clients. That's really a key aspect to address inside of the estate plan. Next, we're going to have Keith talk to us a little bit about how business retirement plans can really help through the business transition process.
Thanks, Jamie. So one of the pieces that's quite often forgotten when looking at transition planning or exit planning is the company retirement plan. So one of the things I always recommend is once you start this process, if you're 10 years out, if you're 8 years out, if you're 5 years out, do a review of your retirement plan. Make sure that you're maximizing those benefits in there as an owner so that if you don't get the sale number for your business that you're expecting, you could have made up that difference in your retirement plan. So make sure your plan is a right fit for your business. Try to maximize those benefits as much as you can as an owner. Make sure you have things like Roth deferrals in there, discretionary profit sharing contributions, some sort of match if possible. For 2018, you were able to maximize out your contributions up to $61,000 as a business owner. It meant that you had to give something to your employees, but that number actually did increase for 2019 to $62,000 with catch-up. So you want to try and get as close to that as possible. Also, keep an eye out for retirement plan red flags. If your administrator is telling you that you're restricted as far as what you can put into your plan, or you have compliance testing failures, or you're receiving refunds of your contributions because of those testing failures, that's a red flag where you should have somebody review that and explain to you why those situations are occurring and what you can do to get out of those situations. Also take a look and review how you can incentivize your employees with your plan. Make sure you're giving them a benefit so they feel a part of the business. Don't forget to determine how your plan will transition to the new ownership. If you did a good job of incentivizing your employees through the plan, make sure that there's going to be some sort of continuity going through to the next owner there. Also, you can use your plan as a recruiting tool right now. That's one thing that I'm hearing from quite a few business owners with the tight labor market that we're seeing is if you want to attract talent, you can really focus on your retirement plan. Shorten that waiting period, increase those contributions that are going in there, but just make sure you're reviewing it. This next slide I have shows a scenario where an employer approached me and they perceived their retirement plan as having a penalty. So they were able to put in contributions for themselves only through employee deferrals, payroll withholdings. Their employees were putting in deferrals, but then they had to give $30,000 a year to their employees in employer contributions through the profit sharing, but they weren't getting anything themselves. I took a review of the plan and figured out if we change the document a little bit, you got to give about $40,000 more to your employees in those matching and profit sharing contributions, but by doing so, you're able to get over $70,000 more as the business owners in this situation. So make sure things are working both efficiently and effectively. That pretty much sums up our high-level review of the estate planning and personal wealth side of the business comprehensive exit planning process here. Hopefully you've had an opportunity to attend some of the other seminars, webinars put on by the CPAs relating to maximizing your business value and how you're going to transition that over and keep the business in place after you leave. But what we've talked about today has really been a good view of what's going to carry you through retirement, what's going to set you up to make it in retirement.
Great. Thank you, Keith. Thank you, Jamie. Thank you, everyone. We do have time for some questions. Again, I wanted to make mention that there is a chat feature for you to ask us any questions. You'll need to open your chat box. There's a chat button at the bottom of the PowerPoint. As you hover over it, just type in your questions. During the presentation, we did have some that came in. First one that I'll ask is, are there any additional ways to manage health insurance costs in retirement?
Yes, there are. One of the ways that you can manage your health insurance costs in retirement, again, is to focus on managing your total taxable income. So in retirement, if you're able to maintain your total taxable income to a low enough number, you may still be able to be eligible for a premium subsidy from healthcare.gov. And Keith, I don't know if you have anything else you wanted to add.
Yeah, one of the options that I've seen take place is as part of the transition, the sale of the business, there's been an agreement to keep the owner that sold the business on as an employee. And as long as you're meeting that 30-hour minimum, even if you're getting minimum pay, you have the option to potentially stay on the health care plan. You can also look and see if your spouse is not part of the business, if they can stay on their health care coverage, or there's always the opportunity for COBRA coverage. You do have the ability to be able to stay on COBRA for 18 months after you leave employment.
All right. Our next question, does the order of what you plan for in business transition matter?
It certainly does matter, but like with any journey, the first step is the most important, and it almost doesn't matter what direction you go in. Today we're talking, of course, a little bit about financial planning and estate planning and what that impact is in the transition process. Certainly there are some things that have to happen in sequential order, but most importantly, to begin the process is the most important thing so that you can start to work out and firm up what your transition plan specifics are. Keith, did you have anything you wanted to add?
Yeah, I agree with you 100%. It doesn't matter necessarily what order you do it in, you just need to do it. But I will say that cash flow planning, figuring out what you're going to need in retirement, or at least coming up with a number of what you're going to expect to have, that's a very important piece. And that one might need to be done before some of those other ones, but it's really more important to get the whole process started.
All right. Another question. How do you handle business interested versus uninterested heirs?
Well, that one can certainly be a challenge because you have the balancing act between people that are, maybe children that are active participants in the business. What you hope is they're active participants in the business and valued participants in the business, and making sure, that they are a valuable member of the business. And if that's the case, going through that estate planning becomes extra important because there are ways to even up or make fair the distribution of the assets amongst the family for those who are a part of the business and for those who are not. It just really is specific to each individual plan.
Agreed, Jamie. One of the situations I've recently run into, I have a business owner who has two daughters. One currently works for him. The other has nothing to do with the business. So in his estate plan, he did write in that if the daughter that currently works for him, if something were to happen to them, she has the ability to buy out the business. It's going to be at a significant discount, and that's going to be part of her inheritance. And then, as you mentioned in your example, his retirement accounts and their estate is going to be equally divided to account for that sale of the business there. But if the daughter that's working for him decides not to take over the business, they're going to sell that business and then split the estate 50-50 in that case. So a properly drafted estate plan, I think, will help to take care of that situation there.
Okay, and we have time for one last question. How do you protect minor young children from a windfall business sale?
That's a great question. I currently have a client who's in this, you hate to say suffering from this situation, but it can be very much a burden for people to address this issue. If you do have children that are minors, especially, and you are going to sell a business that's of high value, there becomes some really important questions you want to ask yourself, because typically, I can speak for myself. I think the worst thing that could have happened to me is if I was 16 and somebody handed me $1 million, that could be a pretty terrible thing for myself, for my long-term financial future. So there are tools that you can put in place. Sometimes a trust is a good idea. That way you have separation between who controls the asset and who benefits from the asset. So essentially it becomes a break or a control mechanism for those assets to be distributed out to the beneficiary at a rate that the beneficiary generally cannot overconsume. So that's one way to do it. The other and most important thing, even beyond the tools that you might use, is to have a conversation with your family about it, to make sure that, the children understand what is happening and they understand the impact of that possible windfall sale. Keith, did you have anything you wanted to add?
No, that's a great point, and one of the things you want to make sure is when you get that estate plan in place, you revisit it on a regular basis in case your situation changes. I'd say revisit it every 2 to 5 years, depending on what your situation might be. I think up until last year, if something happened to my parents, I was going to be a property of my uncle down in Chicago, and I don't think he wants a 38-year-old moving in with him. So my parents did revisit their estate plan, and I'm no longer going to my uncle anymore. So just make sure you revisit that on an ongoing process, just to make sure that any changes that come up you do address to protect those that you're intending to leave assets to. So.
Yeah, I think that's great.
Great. Well, we are officially out of time. Again, I want to thank Jamie and Keith for giving us this presentation today, and thank you everyone for joining in. If you do have questions that come up in the future, Jamie and Keith's contact information is on your screen. Feel free to reach out to either of them at any time, and they will be able to help you. Again, thanks for joining us today, and have a wonderful day.
Thank you.
Thank you.